Good morning, everyone. Welcome to Windsor Brokers live daily market outlook. Today is Tuesday, 13th of November 2012. Continuation of the situation from yesterday and the past week. I would say the euro remains under pressure and posts its fresh two-month low against the US dollar on a sustained break below 127. Support with overnight lows seen at approximately 126.70, which is currently under pressure as renewed weakness keeps the single currency pressure. The euro dipped after the Eurozone and the International Monetary Fund failed to agree on a long-term plan to reduce Greece's debt, preventing disbursement of immediate aid to Athens. The currency was also pressured by the broader risk-averse mood as Chinese shares stumbled during the Asian session following state media reports that government housing market curbs will remain in place, sapping optimism that the world's second largest economy was regaining traction. Greece's international lenders agreed yesterday on their meeting to give the country 2 more years to make the cuts demanded of it, but the Eurozone and IMF clashed over a longer-term target date to shrink the country's debt pile. Obviously, there is no much progress in the current situation with Greece as the strong protest against the bailout plan among the Greek people, and from the other side, the pressure from the Eurozone and IMF officials for Greece to adopt, despite they adopted, accepted basically most of the points, but still implementation, I think it's the point where they are limping. The Eurozone finance ministers that gathered yesterday in Brussels did not disburse more aid to the debt-ridden country, and by granting a request from Athens for more time, face an extra funding bill of around 33 billion euros, according to the document prepared for the meeting. The Eurogroup concludes that revised fiscal targets, as requested by the Greek government and reported by Troika, would be an appropriate adjustment. Jean-Claude Juncker, the chairman of Eurozone finance ministers, said in the press conference yesterday. And he also said that a further Eurogroup meeting would take place in November 20th, while officials said more negotiations could be required the week after that to expected to nail down a new deal. So basically, it's just currently a matter of buying of time for Greece, postponing something that seems, according to my opinion, quite inevitable at this point. But let's see what the officials will decide. At the same time, I said the euro remains under pressure, with the dollar gaining pace against most of majors. Crude oil is under pressure at currently again below $85 per barrel, while gold slides from its recent highs just under 1739. That is the Fibonacci barrier. More of this, of course, we will see in our technical part. Just brief look on the dollar yen that is has lost again the traction on the recent recovery from yesterday's low at 79.06 that stalled at 79.63. Appearance of double doji on dollar yen still shows indecision about the fresh direction, as the pair remains within approximately 60 pips range, but near-term structure remains still negative and more focus seen towards the downside. At the same time, dollar Swiss is above again 95 barrier. This was our initial target and round figure resistance, and a break here is to open way for further extension of the uptrend from 92.13 low. From today's calendar, a number of events, quite interesting things, and important for the most of the instruments. Swiss PPI is out already. We don't have the update currently in the calendar. I will let you know in a second. I think we have it minus 0.1 is the monthly release for October versus minus 0.2, versus 0.2 forecast and 0.3 of month of September, and then later on a bunch of data from UK, starting with at 9:30 GMT. Inflation for October is forecasted at 2.3 versus the September's 2.2. While the core CPI is also for October is also expected to tick higher to 2.2% compared to 2.1%. British PPI for October is seen at 0.2% according to the forecast versus 0.5% of September's release, while retail price index is expected to jump higher to 2.9% according to today's forecast compared to 2.6 in month of September. Also very important releases at 10 o'clock. ZOO economic sentiment for Germany and the Eurozone. German one sounds optimistic, looks more optimistic from the forecast, minus 10.1 compared to optimistic compared to the October's release that was minus 11.5. Today's forecast is minus 10.1. Slight improvement in the economic sentiment is expected. Similar with the Eurozone one that is forecasted to come into the positive territory by 0.2 compared to minus 1.4 release of month of October, and the economic optimism from US due at 1500 GMT, expected at 53.8, just below 54, the release of month of October. And finally, US federal budget balance due at 1900 GMT at shows minus 126.2 billion US dollars compared to the previous month's one at plus 75 billion. Important also is Bank of England's inflation letter that is due to be released today. This basically has the high importance. Pardon, and we are going to follow this. Quick look now at the currencies as action starts on opening of the European session. So we're going to see what we can expect in the coming hours with the major currencies and commodities. As shown on the hourly chart, euro is posting fresh lows against the overnight's one at 126.72, currently at 126.62. Basically the continuation of the down move from now we can say double top at 131.70.38, confirmed by break below important 128 zone barrier support, lows of 1st of October as well as what is that, the 11th of October, and the 200 days moving average that accelerated losses, lower break below 127.40, which is 38.2% retracement, and round figure support now is attempting at 126.37. This is a 90 days, 126.55, the 90 days moving average ahead of our initial downside target at 126.06. This is the 50% Fibonacci retracement of 120.42 to 131.70 rally. Any corrective action at this point faces initial resistance at 127.00 and the more significant 127.38. This is the yesterday's high, and it's also the approximately, as the pair is sliding lower, approximately 38.2% retracement of the down move from 128.75 to the current lows. We don't have a fixed low yet, but this is initial resistance, and basically most likely expected to contain any bounce higher. While break above 127.87, this is the high of last Friday, and the 128 as previous strong support would provide a temporary relief. A negative tone that dominates on all hourly studies as well as 4-hour chart studies, as the pair attempts now through the channel support line that's already been cracked, sees now more focus towards the downside, and basically keeps focus at our initial target at 126.06, with also the quite negative fundamentals seen on the today's releases of economic indicators related to euro, directly related to euro, talking about German and the Eurozone economic sentiment. I would say more pressure seen on the euro today, of course, with the yesterday's Eurogroup finance ministers meeting that did what we mentioned in our introduction speech. So most likely the fresh extension down towards 126 is a more likely scenario at this point, with any retracement, any reversal higher seen as corrective so far, as long as holding below 127.81, 28.00. From the other instruments, cable also remains under pressure following loss of 159 support. This was Fibonacci 38.2% and the previous low of 23rd of October. A fresh extension lower, dipped as low as 158.57, just ahead of our initial support. 200 days moving average currently standing at 158.48. Now, important to mention that we can see we see the consolidative corrective action might be following a fresh dip that dipped to 158.57. So far as appearance of bullish divergence seen, bullish MACD divergence seen on the hourly chart. Let me just draw the line to show it a bit more clear. This could be a trigger for some more significant corrective action. 159.20 zone is seen as the initial resistance. We have the previous lows, previous resistances, high of yesterday at 159.14, 159 is this 55 days exponential moving average, and the Fibonacci retracement 38.2% of the slide from 160.18 down to fresh low at 158.57 is in this zone. Basically, break above here is set to provide immediate relief. However, we need to see the break above more significant 159.50-60 barrier that also includes the Fibonacci 61.8% retracement to ease the bear pressure and probably to focus upper barriers in the near term, but overall the picture still remains quite negative. Also, the bounce could be triggered by quite extended studies on the 4-hour chart, yet no firm signal of reversal seen so far. I would say break above 159.00 is to regain of 159.00, pardon, is to confirm the recovery attempt and prevent pair of delay basically the further bearish extension, as overall picture remains firmly negative, as all the indicators on the daily chart are firmly below their midlines, and the break below 200 days moving averages at this point seen as confirmation of further extension lower, with the trend line, main trend line support, the bull trend line drawn of 152.67, currently standing at 157.58, seen on a break as a target on a break below 158.50, 200 days moving average. We have the round figure support at 158.00, then 50% retracement at 157.87 and 157.58 as set trend line support. On the upside, as we mentioned, the 150 penetration of 159.50-60 would provide relief, while break above 160, 160.30 is to shift focus higher and signal probably the higher low of the recent decline from 163.08 that so far dipped to 158.57. Overall negative tone sees as dominating at this point, and any bounce that will hold below 160 will be seen as corrective on the larger picture, of course. Dollar yen set appearance of double doji shown on the daily chart. We can enlarge it a bit so you can see here. Still shows indecision of investors following the reversal from 80.67, the peak of 2nd of November. That so far dipped to 79.06. holding just above important 79 round figure and the Fibonacci 61.8% support, with the corrective action being capped by descending 20 days exponential moving average at 79.63 during the overnight session. With further range, I would say seen as the most likely scenario. However, the pressure is still on the downside, as indicators on the 1 and 4 hour chart are still negative, though stochastic is reversing now on the hourly one, seeing as a likely scenario further consolidation above 79 and below 79.63. That was the overnight's high. Any penetration through 180 through 80.00, our initial barrier, will be seen as a signal for recovery and shift the focus toward the upside. The barriers 80.43, 80.55, and 80.67. Otherwise, loss of 79 will be signaling a further bearish extension of pullback from 80.67 and open basically 79 zone. We have 79.06 as a low, 79 as a round figure support, and then 50% retracement at 78.90. So we'll put it all in as a one good support 79 zone, break of which we have the immediate moving averages of 55 and 90 days. That 55 days one is just crossed above 90 days, 178.80 and 78.75, and then 78.48, 61.8% retracement. At this point, the daily structure is still in the positive territory, but loss of initial bullish momentum and the slide below 200 days moving average that basically also capped the recovery attempt, sees downside more focus, as all indicators are pointing lower. So further retracement could be likely unless we see the break above 80.00. And finally, dollar Swiss that cracked 95 level, 95.09, seen so far, basically maintaining the positive tone of 92.13, the low of 17th of October 2012, and retracing exactly 38.2% of a larger down move from 99.70 that found support at 92.13. Break above 95.00 opens immediate dynamic resistance. 95.24 is a 90 days moving average, ahead of more significant barrier and our next upside target. 95.91 is the 50% retracement, and the 96.00 is round figure resistance, as seen on sustained break above 95.00, with the daily indicators now firmly in the positive territory. Most likely scenario is the further extension towards the upside. Yesterday's higher low at 94.60-70 zone, reinforced by 20 days moving average, is offering initial support, while the Fibonacci levels of the latest rally seen approximately at 94.20 is the 38.2%, and the higher low of last Friday at 94.27. I would say only break below 94 would be quite risky for the current bulls, as this was the delay, the bullish action, and the open way for a stronger reversal. So far, a positive tone that dominates, sees more potential towards the upside, and sees the initial target 95.24, and then 95.90, and then 96.00. The gold is at the back foot, as investors are taking profit of the latest rally that was capped at 17.38. We are talking about approximately 50%, slightly above 50% retracement of the down leg from 1795 yearly high to 1672.50, and at the same time, I do apologize. This is the Fibonacci projection, Fibonacci expansion, approximately 61.8%, if I'm not mistaken. Yeah, okay, 61.8%, just below this level. The gains were capped. Current pullback is seen as corrective, with the initial support, dynamic support, 1720 is the 55 days moving average, and then higher low at 1712. Main risk will be seen on loss of 7th of November spike low and at 1703 and 1700 as round figure support. For now, more focus is still seen towards the upside, with the Fibonacci levels of the current rally seen as follows. The current lows are approximately at 23.6%, reinforced by 55 days moving average, and ideally reversal should occur somewhere above 1710, as we have 1713, 38.2% retracement, and the higher low of 1713 of 8th of November. So any deeper dips should ideally reverse around this level in order to resume the near-term recovery of 1672. A larger picture is still holding in the negative territory. Studies are still, although pointing higher, but so far the 55 days moving average that capped the recovery attempt and the 50% retracement see increased the risk towards the downside as stochastic is reversing on the daily chart. So there is a risk of deeper reversal, and of course we have to keep an eye on the 17 level break, of which would most likely signal the end of the corrective action, and then focus down towards the 1672. Conversely, break above 1740s to open 61.8% retracement at 1748 and possible extension up to 1763. That marks 100% Fibonacci expansion of the up leg from 1672 to 1731. And crude oil, as we mentioned, remains under pressure with the any bounce higher seen just as corrective. The latest action from last Friday was capped at 86.75, and then now fresh slide below 85 is again turning focus towards recent lows at 84, zone 84.05 and 84.12 seen so far, with the hourly indicators now sliding into the negative territory, keeping the focus at the downside. For our chart slide below 55, that basically limited the corrective action, and now 20 days exponential moving average sees the price attacking the lower boundaries of the current, I would call it consolidative action above 84.00, as a larger picture bears remain firmly in play and seeing more potential towards the downside, as extension of the third wave from 93.50 down towards 84, 83.64 and 80.50 projected levels. Any bounce above last Friday's high at 86.75 would be seen as just providing temporary relief. We need to see the break above initial trendline resistance at 88 and the more significant peak of last week at 89.20 that would signal a temporary base at 84 zone and allow for a stronger recovery. Also to mention that December crude oil expires in 2 days, so most likely from tomorrow we'll be rolling over to the January 2013 contract. That was, I do apologize, that was all from me for today. Do you have any questions, please? Okay, we have no questions for today. Good. It means that we covered all the important points. Thank you for being with us, attending our sessions. So we are back tomorrow morning at the same time. Just as we mentioned, keep an eye on the releases, especially from UK and the Eurozone today. That might have quite a good impact on the markets. and wish you a nice day, and of course very good and profitable trading. Good luck.